A warm welcome. As promised, we return with yet another edition at Hyde Park on other Derana 24. Of course, tonight we thought of talking about capital markets, Sri Lanka's equities, where we stand globally and how far we can go, the challenges that the regulators have and how players in the capital market feel about what's happening in Sri Lanka. I've invited to our studios the chairman of Asia Securities, Dumith Fernando, who's also a director of the Colombo Stock Exchange. Good evening and a warm welcome.
Good evening and thanks for having me.
Thank you. This is our second program for the new year 2020. A lot of expectations. We've been talking about how to develop the capital market, where we'll be in 2020. Are you happy with where our capital markets, the equity market, to I mean, from currencies to bonds to everything, where we stand today?
Yeah, I would say that, I look at the start of the new year and the new decade as really a new opportunity because we are in a good place, but I think we have a long way to go and there's a big opportunity in front of us in capital markets. I'll talk first about equity markets because that's what's probably mostly in the public eye. I think we are underperforming in that. We're, what I would say, punching below our weight class. We have strong corporates, strong earnings, and hopefully, strong policy frameworks coming through with the recent political changes. But for many years, we have had an equity market that has not fully represented our economy. And it has also been only providing benefits to a small investor universe. So just to give you an example, at the moment, our equity capital markets in US dollar terms has a market cap of about 15 or 16 billion dollars. That is frankly tiny in the context of a lot of our regional markets, and that is also, as you know, about 20% or less than 20% of GDP. Yeah. So generally, our target should be to be close to 75 to 100% of GDP in terms of your market cap. So that implies a few things. It implies that the public equity markets are not fully represented by all the corporates and industries. It also implies that valuations are low, and that we can speak about in a little bit.
Sure.
But it also suggests that it is not playing the role that an equity capital market should play in terms of providing savings support for investors, as well as providing capital raising options efficiently for corporates.
When you say our equity market doesn't represent the size of the economy, or that we could do better, but you're also in the industry. We have a regulator. We have everyone setting targets every year. You have over 20 years of experience internationally, international exposure. I was just I wanted to tell our viewers too. Group Chief Operating Officer and Managing Director of Credit Suisse, overlooking the Asia region for 6 years, and JP Morgan in New York and Hong Kong for 12 years. Dumith, I think that's a lot of experience we're bringing here to Sri Lanka. But when we see in the rest of the world, when we talk about the New York Stock Exchange or in Hong Kong, Singapore, we see markets shifting. I mean, there are decisions that are taken that shift markets, it's very sensitive. At the same time, there's a lot of contribution. Yeah. But why? What are we missing here?
I think the participation of not just institutions, but the retail investor base here is significantly lower than what I have seen in other markets. Just to give you some examples, so in my business previously, we had operations in 12 countries, so ranging from large countries like China and India and Japan to smaller countries like Malaysia, Thailand, Philippines. And in most of these markets, you would see that the equity markets are generally traded probably 30 to 50% by retail investors. So that's really important to me because, first of all, retail investors generally take the first step. And you saw that in July of this year, you saw that in October and November of this year, with positive sentiments around the changes in the political leadership. It was the retail investor base that really stepped in first and drove markets to a very good place compared to where we were after the Easter attacks. So a vibrant retail investor community is really important for us, and I think that gap stems in this market from two things. One is our very low financial literacy levels, and we can talk about that as well, but that is a fundamental foundation that we need to build a strong retail investor base. Secondly, I would say the very high interest rate environment, and the fact that combined with low financial literacy, retail investors, particularly those who are not as sophisticated, may naturally gravitate towards fixed income-based instruments, bank deposits, fixed deposits, which have, because of the high interest rate environment, generated a decent return with perceived level of risk that is very low, although we know, it's not entirely the case. The second aspect of it, I think, is the local institutional investor base. The local institutional investor base has also been somewhat limited, and I think the outlook we have had for equity markets over the last 2 or 3 years has been saying that, look, it's undervalued relative to other countries and so on and so forth. But we have had some very large institutions who have been completely inactive. As you know, with everything that has gone on with the EPF, we have not had the EPF active in the equity markets in the last 3 years. They finally came in earlier this year, or rather earlier in 2019, but in a very limited basis. So we need institutions like that to be active participants in this market as well. The third piece is obviously foreign investors. Foreign investors have been doing anything from 35 to 50% of this market. Now that's great when they're active, but what we've seen in the last 4 or 5 months is continuous selling by them. So and that will happen, right? Foreign investors will come in and they'll go out when global macro indicators and other market indicators suit them. But we don't have that support base here. So what you see now is when foreign investors start selling aggressively, markets tend to go down. And if we had a support base of retail and domestic institutions stepping in to capture those sales, I think we'd have a much more stable market. Now, that's what I would call the demand side, right. The buyers, the investors. The supply side of it is actually who is listed on the stock exchange. And that's where, having only about 15% of our GDP in terms of size listed on the exchange clearly tells us that we are not representing our industry in the stock exchange. And so if you look at a lot of our exporters in apparel, to tea, and a lot of other products, they're not listed. They're still very much privately owned, family owned. We have some of the largest state-owned companies, like the banks, insurance company, which are not listed. And you have to think of that in the context of, again, where the other markets in this region are, ranging from very free market-oriented countries like Singapore to communist countries like China. They have listed their banks. That doesn't mean government gives up control. It just means that these are listed, which creates better corporate governance, better transparency, but also an ability for these companies to raise capital.
You're talking about state banks, to list state banks, and you're for this?
Yes, clearly there are a lot of ramifications. I understand the sensitivities, and I understand why that's been such a hard decision. And there are labor-related issues, there are other political issues, but we need to start a gradual process, in my opinion, because see, what we need in a vibrant market is very actively trading stocks. You can go and list 1,000 small companies, but none of these will actually trade actively. If you look at our market today, the ones that trade the most are also the ones that have the largest free float liquidity, like John Keel's Holdings or Commercial Bank. So you need more large companies, not necessarily more companies being listed. And the capacity to list large companies will come from state-owned enterprises, a limited number of them, as well as some very large, family and privately held companies, which, and they all have very good reasons why they haven't listed.
Not many are for listing state-owned companies, which is why I stressed on the very fact, because I remember speaking to Dr. Mark Mobius when he was in Sri Lanka, and he said, be bold, invest state-owned enterprises. But is this because you have international exposure? Is that where the thinking comes from? Or do you have, what is the thinking behind this? Because when you say state-owned enterprises, that's a very sensitive issue, as you said, controversial, and we have seen a lot of issues emanating from how we manage our SOEs. So where does this come from?
So let's take the state banks, for example. So about 30 years ago, the state banks had about 80% market share of bank assets. Today, they probably have about 35%. So what are the things that it'll take for them to grow and grow faster and be more competitive? There are a number of things, but one of them is the size of their capital base. Because as you know, in the banking sector with Basel III capital requirements, new IFRS standards, and other minimum capital requirements that the regulators are bringing in to secure the financial system, which are all good things and necessary things. Banks are getting more and more cramped in terms of lending more, building their asset base, and doing more with customers. To do that, we know with the budget deficits where they have been for the last several years, it's not possible for the state to keep pumping in equity into these state-owned banks. So we need to find another source of equity, and that should really be coming from private capital. So my point there is that listing these is not just about selling them. We're not talking about the government necessarily selling a stake. We're talking about raising new capital that will go into these companies and make these companies, these state-owned companies, much more competitive in some senses.
Right. Very quickly before we go in for a break, I'd also like to talk a little about the foreign selling, continued foreign selling. Although we saw a market reflecting the change of government, the sentiment among investors, we saw market going up. But of course, we did not see the same sentiment from foreign investors, continued selling. How do you look at this? Because that was very important to us also to retain our foreign investors interested in the market.
Yeah. I think there is sort of good news and not so good news. I'll tell you this not so good news first. I think the frontier market asset class in equities has been probably slightly out of favor. This has come partly as a result of very good performance in equity markets in developed markets. So even though, for example, in the US, you had 2% GDP growth last year, the S&P 500 index was up almost 30%. If you look at the last 10 years history, the S&P 500 has returned an annual rate of about 13.6%. Now, that's in dollar terms, and that's very hard to beat. So the most important thing, I think, to attract foreign money is to remember that they have other options. So unlike local capital that is trapped in rupees and they have no choice but to invest in local assets, foreign money always has options. And for them, we in Sri Lanka, but also other frontier markets, have to generate higher growth and higher returns. So what has not happened in the last 10 years is that higher growth and higher returns in equity markets. So it's a little bit natural that investors get a little less optimistic about investing in these markets. Now, the more positive news is more specific to Sri Lanka. Right. I think even though we're a little frustrated as well that the local positive sentiment has not translated into positive sentiment internationally, I think generally speaking, from investors that we speak to, international investors we speak to, I think there is hope, and they're looking forward to coming back because they realize that valuations are still one of the cheapest. If you look at frontier and emerging markets, I think ourselves and Pakistan are probably the two cheapest markets at the moment. We are trading at a forward PE of about a little over 7 times. So they are willing to come in. They're waiting for 2 things. One is to make sure they understand the full ramifications of the political change that's going on. In other words, I think they might wait until there's clarity on the general election. The feedback we have got is an absolute majority in parliament will be positive for markets rather than fragmented coalitions and so on. The second issue is, I think, more clarity on how the fiscal stimulus is ultimately going to be managed and what the outlook will be beyond the first year.
Right.
So I think if we can address those two, and we just need to communicate that to foreign investors and let them wait to see how the political changes ultimately pan out, I feel that we are actually poised well to attract some of them again.
Right. On that positive note, we'll take a short commercial break at Hyde Park. To stay with us. Welcome back. You're joining us at Hyde Park, and we're talking to the chairman of Asia Securities, Dumith, Fernando, who brings a wealth of international experience in international banking, global markets, and wealth management. Yes, we were talking about investors taking a wait-and-see approach. I remember you giving an interview to CNBC and international media stations about investors taking a wait-and-see approach right after the horrific attacks. But is it healthy for us to continue to have investors waiting to see what's happening in Sri Lanka? Yes, that happens globally, but in Sri Lanka, it seems that everyone's waiting to see what's going on to come and invest, and it never happens.
I think that's an excellent point. I think the context of the CNBC interview you talked about was very much around the Easter attacks.
Right.
And clearly that was a black swan event that no one expected, and we were all surprised by, and in our risk models we never priced that in. So clearly, I think in that sense I actually said the wait and see was a positive thing at that time, to say that people weren't panic selling.
Right.
Because typically, as you saw today with the Iran attacks, what's happened across Asian markets and our own markets is markets are down 1 to 2%. That's panic. Right? That's panic around the situation in the Gulf, that's panic around oil prices, and so on and so forth. So after the Easter attacks, initially, I think investors took a wait-and-see approach without panicking, to make sure they understood whether this was a one-off or this was a recurring problem. And clearly our military did an excellent job wiping out the threat as we knew it at that time, and clearly things returned back to normal. Now, the wait and see now is in fact quite irritating, as you say, but this is exactly what I think investors, and frankly not just foreign investors, the local business community is looking for. We're looking for consistency. We're looking for predictability in policy and markets. So for us, I think the opportunity now with some of the recent changes, with potentially a strong executive, a strong parliamentary majority, is to make sure that we have a policy consistency that we can depend on. And expect that we, the business community, can make investments with good predictability of the outcomes. And that goes to tax policy, industrial policy, and a whole host of other things. Those cannot change every 6 months or every year. Once again, it sometimes is so challenging when you work through frequently changing policies to ensure the outcomes that you're investing for. And that's exactly what the foreigners are looking for as well.
When you say, yes, policy changes, we're looking for policy consistency, this is a matter that I have spoken here at Hyde Park and even at previous issues. This has been a problem for Sri Lanka, regardless of governments in power, regardless of what administration. But what can we do from the side of the regulator, from the industry side, in order to mitigate these challenges and have a positive outlook? 2020 has been a big expectation for us here in Sri Lanka.
Yes.
I remember in 2000 we look at 2020 and said we're going to be here, but the question is how far have we come? But what can the industry and the regulator do in order to overcome these challenges?
Yeah, no, it's a good question once again, because you're absolutely right. Sri Lanka, and frankly not just Sri Lanka, a few other countries in the region as well, I would characterize our progress as having been sort of 2 steps forward and 1 step back. we are on the right trajectory. We are hitting good macroeconomic numbers, income numbers. Those are all in the right direction. But if you look at the last 3 years, we've grown at an average of 3.5%. And that's absolutely not where we should be. Number of issues led to that, including some natural disasters, terrorism and other things. But we need to have a capacity to grow closer to the 6% range. I know that's the objective on the President's manifesto, to grow at 6.5% over the next few years. And I don't think that is impossible. I think we'll have to take some steps before we get there. Now, what we expect, once again, as regulators, and by regulator I mean through my role in the stock exchange, we're obviously an exchange, but also play a self-regulating and regulating role. What we need is a market development strategy that lays out, once again, a path to liberalization in certain areas, a path to making it easier to access for investors, and a path that allows us to go and promise the world that here is an investment opportunity that is supported fundamentally by good growth opportunity, but also not going to be derailed through road bumps in terms of surprises on regulation or taxes or whatever else. Now, running an economy is a tricky thing. I know running a business is a tricky thing for me, so running an economy is going to be 100 times harder. And so you have to be dynamic. You have to change policy sometimes to meet our needs. But I think the important thing is that we develop a game plan that has the right intentions at heart, which is that we want to make or develop a country with prosperous citizens, and that we are going to recognize what's unique about Sri Lanka when we do that.
You mentioned about liberalization, but this is not something that we in Sri Lanka are we accept openly. We're rather skeptical sometimes when you say liberalization, whether it's going to be too loose for us to have control over. But when you say liberalizing, how far and what do you mean here?
Yeah. So, I think we have to think hard about the role of the private sector and the role of government. I am not one of those who sits there and always complains about the government not doing something for me. And I don't think the business community should make that their default state of being. If you're a competent business leader, I think you take what's served to you, whether it's government, external factors, and so on and so forth, and you try to find a way. And I think the rule of creative destruction in the industry speaks to the fact that those who can work within that environment and achieve good business models will survive, and then some of the others will probably find it much harder. So by liberalization, what I mean is that we need to take away, first of all, the bureaucracy and the red tape where that exists. And that's not just a government thing. That exists in other organizations, including the private sector. Secondly, we need to create transparency in markets and access. So we need to create investment opportunities that are transparent. We need to create ways in which people understand what their markets are and open up market access. We also need to think of liberalization in terms of allowing outside knowledge to be brought in here.
Right.
If you think of the Asian tiger economies, how did they grow? Most of them grew through high-tech manufacturing growth. That high-tech manufacturing growth wasn't always homegrown. They invited a lot of foreign expertise and skills, and they found smart ways in which they didn't allow local industry to be taken over, but they found smart ways in which to transfer those skills. And that's what we need. If you think about the biggest challenge I think we have in the long term, not just over the next 5 or 10 years, is how do we reform our economy to be one that is based on innovation and technology. Now, let me give you a small example. I looked at the top 10 market cap companies on the Colombo Stock Exchange 15 years ago, and then I looked at what they are today, 70% of the companies were the same, right? Then I looked
over
at
a period of 15 to 10
over the last 15 years. Then I looked at, for example, the S&P 500, companies in the S&P 500. 25 years ago, 8.5% of the market cap of the S&P 500 was tech companies. Today, it is 34%. Right? So you see, they've allowed innovation and new sectors to grow, new sectors that are built on higher levels of skill. And that's why, despite the fact that we like to think developed economies are not growing, they continue to provide some of the best investment opportunities. So we need to think about liberalization in that sense, right? We need to think about where our excellent, labor capacity and human resource capacity is currently employed, and whether they're doing the most productive things, given that we're not going to be a cheap labor environment as a middle-income, upper middle-income country. Right. Now, again, I'm not saying something that people haven't recognized before, but I would say that some of the steps that need to be taken, which are long-term, have not necessarily panned out exactly that way. I know just recently, I think yesterday I read the news about funding for 10,000 tech-related jobs or training for 10,000 tech-related roles. So like that, I think we have to actually...
Yes, there's also a massive drive to improve IT and that kind of industries, tech and AI. There's a new interest in AI in Sri Lanka, which is interesting. We'll talk about that when we return after this short break. Do stay with us. Welcome back. You're joining us at Hyde Park. Yes, we were talking about the challenges that industries face, the market faces, and Sri Lanka faces going forward. And of course, you had some really good suggestions on how we can mitigate these challenges. But let's get back to financial literacy. Very low literacy. Yes, you mentioned this, but this is something we've been talking about for a while. And retail investor participation. We've been talking about trying to improve this, shifting from retail, moving away. But what does this really mean today? How do you look at this? How does the outlook seem in the global market, and how do we translate this to investor involvement in our market?
Okay. I will sort of forget the business I'm in for a moment and considering myself a Sri Lankan. I will say first, the importance of financial literacy is much more about how we support the growth of prosperity amongst our people. Now, to me, prosperity growth is two things. One is growing income, which is where most of government and other efforts are. The second is growing savings and wealth. So you go, you make your money because you get good jobs in a good economy. But what you do with that money and how you grow it is as important in securing your financial future. We think we have strong financial involvement and participation because something to the tune of 85% or more of people households have a bank account or a financial account. But less than 30% of people have any kind of personal credit. Much smaller percentage will have even a more sophisticated credit product like a credit card. Much fewer people will have an investment product outside a savings deposit. And that's not a way to make our population wealthier. And I think it's really important for us to think about financial literacy, not in terms of how it'll help capital markets alone, but how it'll help the person on the street in Colombo or out in the rural farming communities. So to us, financial literacy really starts with personal financial management well before you start getting into investment products and so on. But the challenge has been that unlike many other countries, you don't get a formal education in this unless, say, you're studying commerce at A levels. Countries like, even poorer countries like Bangladesh have formalized financial literacy in their curriculum. Countries like Thailand have done this. So it is critically important for us to develop better knowledge of how you plan for your future, how you secure your future through what kinds of products and what suits your needs at different stages of your life. Because what you can do, the risk you can take as a 28-year-old is very different from what you can do as a 55-year-old. You need to remember, that our retirement age is around 55. Our life expectancy keeps going up. It's close to 80 now. So what that tells you is for 25 years, you're going to have to live without necessarily a primary income. Yes, of course, you can go do contract work and do other things. But the crux of the matter is that you need to have saved up a nest egg by the time you're 55 and then invest it smartly.
So that it'll last that 20, 30 years.
Exactly. So you take away external dependencies and you can be self-sufficient. To me, if everyone is doing that, we've reached a very good place in our country and our economy. And so that is why I think financial literacy is very important. We've done many studies and we've actually done some of our own surveys and found out that in terms of holding back from investing, the most important challenge even with educated people is the lack of knowledge on what they can and should be doing with their finances.
So when you say, do we start at schools? Do we start with the curriculum improving this? Or should government look at other ways to inculcate financial literacy, to improve literacy in financials in Sri Lanka?
Once again, I'm going to say this again. I'm not one of those who believes that every bit of responsibility on this lies only with the government. Of course, the education department and other government agencies can in fact play an important role in this. But I think there's an important role that a responsible private financial sector can take here as well. So I think we should be investing. Ultimately, for the financial sector, what are you actually doing if you invest in financial literacy? You're investing in growing your client base. Right? You're investing in your client base so that they will buy more product from you, invest smarter, and potentially turns that into a win-win, where the customer is making a better return, and as a financial service provider, you're making a better return. So we need to change that mindset that growing financial literacy is just a government responsibility. And I can't, off the top of my head, think of any strong financial literacy program that has been championed and invested in by the private sector. And I think it's time that we all gather together and push that.
Let's move on to talk about the global economy and the market outlook, 2020 and beyond. What are your thoughts? How can we help our economy maybe benefit from this, have a trickle-down effect also?
Yeah. Look, I think the good news, so a few months ago, there was a lot of talk about US recession. The indicators that we see now in terms of industrial production and purchasing manager indices, as well as labor statistics in the US, points to the fact that that recession is probably overblown, or the fear of it is overblown. So we are actually predicting that the US will grow at a positive, call it around 2%. We do feel that Europe is also showing some signs of health. Right. So the three big parts that impact the global economy these days is the EU, US, and China. China is also, bottoming out, I think, in terms of its challenges. Credit growth is actually, in double-digit levels. And we do see that they had an impact from the trade wars of last year. Our sense is the trade wars will actually reach some kind of positive conclusion. Now, how does this all affect us? Clearly, for our export markets, the US being the biggest one, it's very important that there is a robust, growth rate there. particularly because, particularly in the apparel sector, consumer spending obviously plays a big role, but also we have other products that, go into the US and Europe. China is an interesting one because as the trade wars have evolved, what has actually happened is a lot of manufacturing has moved out of China. Chinese companies have moved it into other markets like Vietnam, Bangladesh, and we should really be looking at which opportunities we can get out of those as well. But generally speaking, we think it's going to be a pretty decent global growth environment. No cause for alarm. Now, having said that, as of 2 or 3 days ago, the tensions in the Gulf with the US attack on Iran and the retaliation this morning, clearly, if that disrupts oil markets, that's a huge impact for us, right? So,
right. On that note, we'll take a short commercial break and be back to speak more. Welcome back. We were talking about financial literacy, how to improve investor confidence and attract investors in the market. But also, you did mention about having companies list on the Colombo Stock Exchange. But a challenge that we saw in the past was also that some of these companies, they would list, but they were highly or way too valued. And then soon these stocks crashed. But how do you look at this in bringing companies into the stock exchange? Yes, going for IPOs, but how do you sustain and what should they know before they come in without blindly going in for IPOs just because that was a regulatory requirement?
Yeah. Look, I mean, listing a company is more than just raising capital. It's about creating a governance process that is in line with the listed company governance. That will strengthen companies. It is about creating transparency, which will, ultimately drive performance. It is about the ability to create a currency that you can motivate your employees with through ESOP programs and so on and so forth. It is also about professionalizing management, particularly for the large number of family-owned businesses that we have today. Now, these are all benefits of being listed. So it's not just about raising money in the public market. Of course, there are challenges with being listed. You have some requirements and so on and so forth. But for the right companies, the benefits will far outweigh the challenges. Now, what should you think about? You should think about whether you are committed to running a company that will, live within the expectations and regulations of listed companies. Second, you need to think about whether you have a sustainable business model. You cannot bring companies to IPO off one good year. You have to take a sustainable business model, and that's what underwriters, investment banks who act as promoters of these companies really need to think about. You need to think about the quality of the management teams, the business models, and the outlook for the market that these companies are operating in. And also, I think it creates, particularly for new economy companies, and we have a few e-commerce companies, for example, who are speaking to us now about going public, which delights me to no end.
Right.
Because these are exactly the types of companies that we need to show success stories of. We have plenty of potential to create these companies. The markets may be a little smaller than big neighbors like India or Indonesia, but these are good business models where there's sustainable earnings, and it's an opportunity for early stage investors to exit as well. And then ultimately, if there are good companies, it's also a great opportunity for the masses to, ride that wave and ride those earnings. So I think it's there's more education that needs to happen in some cases in terms of the benefits of listed companies, but at the end of the day, what we're seeing now is more, even some very, long-term family businesses are getting to that stage where the patriarch or, matriarch of the business wants to, move on. They don't necessarily have a next generation that they want to hand over their businesses to, and they do see listing as a good option to maintain the continuity of that business, because that will professionalize management and allow these companies to thrive. So, we have a positive outlook for the economy in general. We have a positive outlook for a number of industries underneath that economy. We would love to see more of these companies considering the IPO option.
I'd like to go back to international foreign investors. Yeah. We talk about financial tools, making available tools that these foreign investors will be interested in order to attract them. You have a wealth of knowledge and experience in international financial markets. What do we do here in Sri Lanka? What would you tell our companies, large companies too, even if our state-owned enterprises are to invest? How do we target foreign investors? Because this is something we need in order to grow as an economy.
Yeah. Well, I'll just say one thing, which is good stories that sell themselves. If you have good companies with good earnings potential and good growth stories, the investors will come after you. You don't really have to go after the investor. Now, having said that, there's a role for every one of us to play. I think the stock exchange takes its role very seriously in promoting the market and the investment opportunities. There's a group of our members, stockbrokers, who actively market opportunities internationally. The government and policymakers have been very helpful in joining some of these promotional road shows that we do internationally. So we've got to keep the communication going. But at the same time, we have to continue to be out there. In difficult times, so soon after the Easter attacks, we had scheduled a stock exchange roadshow in Singapore in May. And a lot of people told us, no, you shouldn't go because it's a bad story now with the attacks, and the stock exchange and the SEC jointly made the decision, no, we will go ahead. We will not be absent in this time. We will go ahead and talk about the positive story that will happen beyond these attacks. So it's up to us, I think, really, to keep telling that positive story. But fundamentally, it comes down to, I'll turn the tables and say, if you're an investor and you have, 1,000 rupees or 100,000 rupees that you want to invest in something, at the end of the day, it's not, what story I tell you, but it's ultimately whether you're convinced it's an opportunity that's going to give you your money back and more. So we need to create that environment where, through manageable tax rates, low interest rate environments which would reduce the financing costs of these companies, and through sustained demand growth through local and international market access, we are creating an environment for companies to thrive. And then we have a well-regulated market where there is good, decent, ethical behavior, where an investor is not going to be afraid to come, whether you're local or foreign. Frankly, to us as an exchange, the individual retail, if you're a 75-year-old man or woman investing in this market, it's as important for us to protect you as it is for us to protect a big international investor. So if that environment is in place, I think we can very easily sell our good companies.
Thank you very much for your time, and all the very best to our capital market, our stock exchange, and our industry for a prosperous 2020 and decade ahead. We had with us a chairman of Asia Securities, Dumith Fernando, who is also a director at the Colombo Stock Exchange, formerly Group Chief Operating Officer and Managing Director of Credit Suisse Asia region and JP Morgan in New York and Hong Kong for over 10 years. Thank you very much for joining us here at Hyde Park. We'll see you again next week at the same time, same place.
Thank you very much.
Thank you very much.